Welcome to Financial Planning Explained. I'm your host, Mike Menninger, Certified Financial Planner, owner and founder of Menninger Associates Financial Planning. I'm pleased to have joining me today as my co-host Kyle Ryan, also a Certified Financial Planner as well as a Chartered Financial Consultant. Thanks again, Kyle.
Thanks for having me.
So we're going to pick up with our third of three episodes talking about just basically answering questions that people ask with regards to taxes. It's not as much tax planning, but we get into some of the tax planning ideas that go beyond the question that's being asked. You ready to go?
Let's do it.
All right. So I know we talked about this in the first episode, looking at this question, but how do Roth IRA conversions help reduce my taxes in retirement?
Well, ideally, when you did them, you were in a lower tax bracket then than you are in retirement, so that you are able to access retirement income without having to pay taxes on it, which you ideally did at a lower rate then than you otherwise would have today.
Well, and the fact is that how do they help you reduce taxes in retirement? Well, Roth IRAs are tax-free in retirement, as long as you meet the two criteria.
And this is going to get into, because I took a sneak peek at the ahead questions, this is going to get into questions ahead, but it builds flexibility. It really builds flexibility. Let's say you have a $40,000 need in retirement, whether it's the roof goes, you name it, something happens, but you have certain types of assets you can go to. But if you take on an extra $10,000 of income in retirement, your IRMA is going to get impacted, your Social Security is going to get impacted, you name it. This is a way of taking from another type of account, tax-free, without impacting other types of taxable events, such as the ones I listed.
Right. No, that's a good point. And we do that all the time. In fact, it may be that during retirement, they need to live on $50,000. The first $30,000 can come out at really, really low tax rates. But after they get past 30, it's now all of a sudden taxable. That's what you do is you take your 30 from your taxable sources, and then you take the balance above it from the Roth.
He hasn't seen the next question yet, so go ahead.
Oh, boy. All right, so next question. When should I start withdrawing from my retirement accounts to minimize taxes? Well, it's asking when. When should I start withdrawing from my retirement accounts? When? Well, first of all, you start withdrawing when you need them, but not necessarily. We've got clients who are actually looking to retire at a young age, 56, 57. And what we're looking at doing is moving money out of the IRA into the Roth IRA while they don't have any other income, and then living off of their savings type of assets. Yep. And now by doing those conversions, we're moving money from a taxable bucket over to the tax-free bucket and paying a very, very low tax, so that when they pull it out in retirement, to the point from the thing we were talking about earlier, they can maximize their tax efficiency by grabbing the appropriate amount from one bucket, and they have multiple buckets to grab from.
Yeah, like you started saying in the beginning, look, you have cash flow needs. You have to fulfill them from somewhere. And then we take a look at what type of assets, what type of taxable buckets you have, and we just try and be as tax efficient as possible. Like Mike mentioned, sometimes you live on non-qualified assets and you save your retirement assets for later, whether you're doing tax strategies like Roth conversions. Sometimes people retire and they haven't built up anything other than retirement accounts. And that gets into, well, you have an IRA and a Roth IRA, you take the IRA up until the point that it makes sense, and then the Roth IRA fills in the gap after that.
Yeah, and so for those people too, what we've also done is, if they need to be pulling $40,000 to live, but they can squeeze $80,000, let's say use a different number, but they could squeeze $90,000 out at a low tax rate. What we do then is we'll do a conversion of $90,000 at the very beginning of the year, and then we carve out $40,000 inside their Roth IRA into guaranteed interest type of assets, money market, or what have you, earning 4.5%. Well, by doing that, what it does is we converted the full 90, and now that 40 that they're taking out is earning interest on the tax-free side of the ledger. Yep. And the 50 that they didn't need, well, that remained in the Roth and grows tax-free. And if it turns out that they needed more than 40, well, it's already there in the Roth.
Yep. The last thing I'd add to it is generally you don't want to touch your retirement account until you're 59.5 because you'll get an early withdrawal penalty on it. But we have had clients who retired at 55, specifically 55, and you're actually able to withdraw money from a 401k at that point. There's a lot of complexity behind that we won't get into, but really it comes down to what's your unique financial circumstance, and it's the best way to plan around it.
Right. Let's figure out a way. There's usually a way for you to accomplish what you want to accomplish in the most tax efficient manner. And also, again, you can pull in money from your IRA if you're living off that in retirement. You can always withhold the taxes and send it to the government. A lot of people do that, and that's fine. Yep. That's fine. All right, next question. How do required minimum distributions, or RMDs, impact my tax bill?
They add to it. They add to it. A lot of required minimum distribution. Let's start with what a required minimum distribution is. That is when you have a traditional IRA or a pre-tax 401k, and currently the age you have to be to start taking that is 73. I believe in 2033, if you turn 75 in that year, that's when you have to start taking your required minimum distributions. They're increasing it as people grow older. How does it add to? The only type of required minimum distribution is a taxable required minimum distribution. They've gotten rid of the Roth RMD. So how does it impact your taxes? You pay tax on any amount that you have in a required minimum distribution. What is the required minimum distribution percentage you have to take out? Depends how old you are. It used to be 4% roughly. Now I think the first year you have to take it out, it's roughly 3 1/3, 3.5%, somewhere around there. Based on the value of the size of your account is how much you have to take. So short answer is, how do they impact your taxes? They increase your tax bill.
So if I was 73, the way it works is there's a factor in there, and it's a published factor by the IRS, and if that factor was, say, 22, what happens is that we take the value of my IRA account from December 31st of the prior year divided by 22. That's how much I have to take out, okay? And it's actually not 22, it's probably like 27, 28, something like that. But, it ends up being about on the shy side of 4%. So the other thing that, and if I'm answering a question ahead, because I didn't look ahead, is those people have also reached age where they have to take required minimum distributions, can also do what's a relatively new rule called qualified charitable distributions. That is where they can take the money and basically from their IRA, write a check from their IRA and send it directly to a charitable institution. And effectively what happens is the money comes out and there's no tax on it. So it's distributing IRA money without paying tax. A lot of people will do that with their RMDs, because if they have a $10,000 RMD, well, rather than taking that $10,000 worth of income, because you have to take it, okay? You have to take it or else it's a 25% penalty. Used to be 50, which is stupid.
Yeah, until recently.
I know. So you have to take it out. So what they'll do is they'll say, hey, you know what? I'm making charitable contributions anyway. Why don't I just write checks for my IRA so that it's not considered taxable income?
Talk about a mistake in taxes from the last episode. There's a good one.
Right.
A lot of times people are giving thousands, tens of thousands of dollars to a charity, whatever kind of charity. That's from your bank account. Do it from your IRA. You got to take out the money anyway, and you're going to save 30% of the money.
If you're over 70 and a half, which is the old RMD age.
Okay. They kept that there and didn't move it. Don't ask us.
Right, exactly. They forgot to consult with us. Was there something else that I wanted to say about that? I'll tell you what we use RMDs for a lot is we'll use the RMD as the sacrificial lamb. Yeah. So if someone owes money for taxes, what we'll do is we'll utilize their RMD. Let's use that case that I was just saying. They have a $10,000 required minimum distribution, and they have other income sources, whatever the case may be. What we'll do is if their tax is going to be about $10,000, we'll take a withdrawal on or around December 31st, and we withhold 100% for IRS, or we even do it for the state too. Yeah. And basically what happens is that you're keeping an earning interest on your money all the way to the end. Why give the government money earlier than you have to? And what's important to know is we also referenced the self-employed individual who has to make quarterly estimated payments. Doing a withholding from a retirement account and directly to the government is considered to be making quarterly distributions throughout the year.
Yeah. Like if you withheld $10,000 at the end of the year, it counts as $2,500 a quarter. The same thing goes for payroll withholding.
Right. Exactly.
Yeah.
So
the last thing I throw in here is inherited IRAs. Depending on when you inherited it and the age of the decedent you inherited it from, also have required minimum distributions that can take on their own planning. Usually we'll use that as the quote-unquote sacrificial lamb for taxes as well. That's really situation dependent.
right, and also know that there are two different inherited IRAs and rules associated with them. The inherited IRA from someone who passed away prior to 2020, which is 2019 and before, basically created an RMD for the beneficiary.
Yep.
So if I received an inherited IRA from my parents or whatever, and I'm age 50, my life expectancy at 50 might have been 40, which means that I only had to take 1/40th of my account out. However, that RMD continues for the rest of my life, and every year I have to take a little bit out, a little bit out. However, what changed in 2020 is they made it so that the beneficiary has to take it out within 10 years.
Yes.
And trust me, that has created enormous tax planning things that you do if you happen to have a large 401k or IRA.
Yes. Yep. Depending, what age the person you inherited passed away from will determine if you have to take out an RMD each year or not. So there's a lot of really cool planning strategies behind that.
Yes, there's lots of them. All right. Tell you what, we're at a good point for a break. So tell you what, we'll take a short break right now, and we'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained as we continue on with more questions on taxes. And we'll pick it up where we left off. What is an HSA or health savings account, and what are its tax advantages? Let's try that again. What is a health savings account, which is an HSA, and what are the tax advantages? I'll let you pick up on that.
Sure. It's the HSA is commonly referred to as one of the only triple tax advantaged accounts in that when you contribute to an HSA, let me back up really quick. An HSA requires a high deductible health plan in order to be eligible to contribute to it. So if you have a high deductible health plan, you can participate in an HSA. Why can an HSA be really valuable? Because of the tax treatment of it. You put money into an HSA, you get a tax deduction. If you invest your HSA and it grows, you do not pay tax on that growth if, when you distribute it, it's for a qualified medical expense, which the list of qualified medical expenses for an HSA is incredibly extensive. It's amazing what it can be used for. So think of an HSA, you're building it, you're in your 20s, 30s, 40s, you name it. If you're in your 30s and 40s, you might be more apt to use it for your children, but one of the biggest advantages of an HSA is, again, the tax treatment of it. You got a deduction going in, and you don't pay any tax on the growth of it, which means that if you're able to contribute to an HSA throughout your entire life, invest the money, and not have to tap into it for use of medical expenses, what you can do later in retirement is you can actually use your HSA to either reimburse yourself for past medical expenses or use it for medical expenses that you incur in retirement. Think about that for a moment. That's where, think of it compared to a Roth IRA that you get a tax deduction to contribute to.
Not a Roth. You don't get a tax deduction?
But that's the difference. Imagine it's
yeah.
like a Roth IRA, you got a tax deduction to contribute to. So you put, say, the limit for an individual who's not married is somewhere in the $4,400 range. If you're a family, it's like $8,800. But say you're an individual and you're putting something like $4,000 in there for 20 years and you're letting it grow in some sort of investment fund, and you go and you either reimburse yourself for all those times you went to the doctor, had healthcare expenses, or you have medical needs later in life, you have this fund of money, this tax-free fund of money that you've built that you can use for that. It is such, as people get older and as healthcare costs increase, this is a way that a young person, no matter how old you are, because there's increased catch-up load, like you can really put money into this and have it be a very, very tax advantageous account for yourself.
Absolutely, you got to play the game right. And then, so all the years that you're living, you just want to have a decent storage for all of the receipts of the medical expenses that you incurred.
Very good documentation of it. And it's going to be really hard when you're, say you're 40s and you got 20, 30 grand in there, or you name it, and you have a kid that, if they have to go to, if you need to use it, use it. But if you don't need to use it, let that thing grow tax-free for as long as you can. 2 favorite words right there.
That's right. Love it. Love it. The HSAs are great, and they're relatively new, too.
Yep.
They replaced the FSA.
I was just going to thank you for bringing that up. It's very different from a flexible spending account. A flexible spending account, not that this was a question, but it's use it or lose it for most plans. So if you put $1,000 into an FSA and you don't use it, kiss that money goodbye. An HSA can be carried over year to year, but you have to have a high deductible health plan for it.
And I always hated the FSAs because of the fact that you always want to underbid what you think you're going to use.
Yes.
Because,
it's wasted money.
It's wasted money. I know. I hated it.
Yeah.
Oh, my goodness. All right. This is sort of another sort of repeat question. Should I withdraw from my 401k or Roth IRA first in retirement?
Depends on your tax bracket.
It depends.
It depends. Look at that. Like most financial planning questions, it depends. It depends on the tax treatment of that distribution. What are you still first in retirement? It really depends, right? If we're taking it this year, when tax brackets may or may not be extended next year, it's tricky. It is really tricky. It really depends on your situation.
Exactly, and every year could be different.
Yes.
So, I wish we knew that question was there.
Earlier, we could have tackled it.
How can charitable giving lower my retirement tax bill? And the examples they used here are the qualified charitable distributions, QCDs, which we talked about, as well as DAFFs, donor advised funds.
Yep.
So we talked about qualified charitable distributions. Donor advised funds are also pretty cool, okay? Particularly in today's tax environment where you have very large standard deductions. And so what happens is that the standard deduction this year in 2025 is $30,000. And because the state and local tax SALT is capped at $10,000, that means I have to have $20,000 in charitable contributions and mortgage interest before I even see the first dollar that gets deducted. And if I don't have a big mortgage, I'm leaving a lot of money. Like if I have $10,000 in mortgage interest, which is $250,000 mortgage at 4% is going to give you $10,000 worth of interest.
The average interest rate these days on mortgages aren't that high either.
No, they're not, because most people got their mortgages before the interest rates went up. So I would have to have $10,000 worth of charitable contributions before I begin to get my first dollar. But you could front load it. And there's a term for it, and I forgot what it is. I don't think of stinking terms. I just do what makes sense. But what I'll do is if I'm consistently donating $10,000 a year and I'm effectively not getting the tax deduction because I'm $10,000 away from reaching the top of my standard deduction, well, why don't I just contribute $30,000 this year? I contribute the money to a DAFF, donor advised fund, and the first 10 may not have been tax deductible, but the other 20 was. And what makes it even better is that I can contribute appreciated assets. So take, for instance, rather than just coughing up 30 grand in cash, let's say I have Microsoft stock that I bought for $10,000 5 years ago and it's worth 30. Well, geez, what I can do is I could take that $30,000 of Microsoft stock, stick it into the DAFF. What did I do? I avoided $20,000 in gains.
Yep.
So that's a beautiful thing, and we've used that plenty of times for clients who, like to donate a lot of money. We're like, well, wait a minute, let's do it this way and utilize the DAFFs so that you can push more money in a particular year, and then subsequently moving highly appreciated securities. Now, once that 30 grand is in the DAFF, it's a completed gift. I can't get to it anymore. The other thing that happens is that, let's say that 30 grows to 35, I'm not getting that $5,000. And in fact, because it's in a charity, it's not getting any gain on it either. But what happens is then from that point moving forward, I can now piecemeal out of the DAFF if I want to send $1,000 to the church and $500 to the Boy Scouts and another $1,000 to a different charity and $5,000 to this. You just basically distribute it from the DAFF as much or as little as often as you want.
I've got a question for you.
What?
If you have someone who has charitable inclinations, what would you lean more toward, a DAFF contribution or a QCD?
QCD all day long.
And why?
Because what happens with a DAFF contribution, it's a deduction on Schedule A. But if it's a QCD, that means I have to be at least 70 and a half years old, which means I am on Social Security and I'm at risk of, like for instance, I'm taking them out, they're what's considered above the line deductions, which means that those numbers that I'm distributing from my QCD are basically monies that would have been coming out of my IRA that aren't causing my Social Security to become taxable, and similarly may not also impact IRMA.
And how is that different than a DAFF? One more time.
And a DAFF is on Schedule A, which is an itemized deduction.
Which has a lower tax treatment.
Right, correct.
Yep.
Correct. So thanks, good question.
Yep.
All right, I knew you knew the answer.
Yeah, I'd hope so.
I know, exactly. All right, a couple more questions here. How do tax brackets change for married couples versus single filers? I'll let you take that because that has come up several times before.
I've had a couple questions recently, and basically what I've had is people who are getting married. It's 2025 now, but they were getting married in 2024. They were like, they were getting married in 2025. We had this conversation in 24. They were like, should we just elope? Would it save money on taxes and then still have the big wedding and everything? So people commonly ask us, just how do I save money? We're going to get married. Should we file jointly? Should we file separately? How does it work? And really, this is something you're going to want to go through if you're wondering this on an annual basis because it could change. But what we've most often found is that you get the benefit of combining income, married filing jointly, when there's a really big discrepancy between the two incomes. If they're relatively the same, if I'm making $100,000, my spouse is making $100,000, it's not going to have the largest impact. And we've even seen it where it actually is negatively impactful, where you actually spend more taxes filing jointly than you otherwise would have separately. But generally speaking, if there's a larger discrepancy in your income, there may be a greater advantage. Maybe, don't take this at its value. You really want to go through the calculations, but there's a lot of different pros and cons to it. You just want to run the calculations yourselves each year when you're making that evaluation.
You hit the nail on the head. It's rare that you find that getting married has a higher tax. In fact, it's usually lower, yes, especially if there's a disparity in incomes.
Yes. Yeah.
Because if one person's making a lot of money and they're on the single side, they're hitting the higher tax brackets faster.
Yeah.
And by bringing in the lower income and filing married, because the first several tax brackets for the married is double single. So for instance, the first tax bracket is like $11,000 for single, $22,000 for married. And then the next one's $48,000 for single,
Yep.
$96,000 for married. Then $100,000 for single, $200,000 for married. $200,000 for single, $400,000.
And then where it gets tricky is if you have a kid, because then one of you gets to file head of household. And I've got a friend who's on number 3 now and still no wedding ring. And I'm like, dude, you're just missing out on a tax break. Like, you guys are so different in income. But I digress. That's where you just really want to run the calculation, run it through a tax software, something like that. Ask your accountant, and that's how you want to determine it. It is an annual thing based on each of your individual's income.
Correct.
Yep.
Correct. And, don't get married just for the sake of a tax break. Get married because you're in love with each other and you expect it to last forever. But again, there are advantages and very, very few.
Yeah, my brother's in the military. Don't tell him that.
Yeah, right. All right. This is probably time for the last one. Yep.
Yep.
All right. What are the best tax deductions and credits that I should know about?
The ones that save you the most money.
That's correct. Those are the ones that we want. So let's first talk about the difference between what a tax deduction is and a tax credit.
Yeah, absolutely. So I'll start off by saying a tax credit is almost 100% of the time more impactful for you. Let's start with a tax deduction. You make $100,000. You spend $10,000 on something and you get to deduct it against your taxes. You're not taxed on 100, you're taxed on 90. That only means you pay less tax on that $10,000. If you're in the 20% tax rate, you saved yourself 20% of $10,000, you saved yourself $2,000. That is far different than if you make $100,000, you get a $10,000 tax credit. It credits money in your pocket. That is dollar for dollar reducing your tax bill and or increasing your refund. On that note, there are different types of credits. There are refundable credits and non-refundable credits. Some types of credits reduce your tax bill down to zero. Other types of credits can actually increase your refund amount. What's the most commonly well-known type of tax credit is the child tax credit. What's the most commonly type of deduction well-known is either a 401k, a retirement account deduction, your standard deduction. They deduct the amount of income you pay taxes on. A credit, always want a credit, that is money in your pocket.
Right, and the most common tax credits are the earned income credit, which is typically for low-wage earners who have children. Then the child tax credit, which is available to anyone, albeit it's income tax dependent. And what it is it's based on your adjusted gross income. If you're single, your adjusted gross income needs to be under $200,000, and then if you're married, it needs to be under $400,000, which those numbers went up precipitously. And the tax credit is $2,000 per qualifying child, which means they needed to have not turned 17.
Yes.
Okay. And that's a pretty big tax bill. And then the other ones that are common are the various tax credits for tuition, college tuition. You have the there's one that's $1,000 lifetime learning credit.
The American Opportunity Tax Credit.
Right.
You get to deduct your student loan interest that you pay. Yep. So yeah, that's they offer credits and deductions for similar types of things like student loans, but they behave very differently in how they impact your tax bill.
So that's about it for today. So thank you, Kyle, for joining. And I hope everybody learned something, and we'll look forward to seeing you on the next episode of Financial Planning Explained. Have a wonderful day.